Oh my God, listeners, you won't believe what's unfolding in the market right now. Novo Nordisk, the multinational powerhouse, is facing a moment of reckoning, and it could be your next big move. Their stock just plummeted nearly 20%, sitting at 85.57. That's flirting dangerously close to its 52-week low of 82.17. And the story behind this drop is sending shockwaves through Wall Street. Here's why. Their highly anticipated weight loss drug, CagriSema, fell short in its final clinical trials. Investors are calling this one of the worst trading days in the company's history. But here's the kicker. Despite this chaos, analysts are doubling down on their buy ratings, with a jaw-dropping price target of $140. That's a potential upside of over 45%. Are we looking at an overreaction? Could this be the opportunity others are too shaken to grab? Look, I know you're thinking, what about the big picture? Well, here it is. Economic data's a mixed bag. Inflation's creeping up, hitting 2.4% on headline PCE and sticking at 2.8% for the core, while unemployment's ticked slightly higher at 4.2%. That doesn't scream consumer strength. And yet, retail sales surged 0.7% in November, with cars and online spending leading the way. People are still buying. Layer onto that a strong 2025 manufacturing outlook, and the macro environment isn't as gloomy as headlines suggest. So what does this mean for Novo Nordisk? Fundamentally, they're still solid, backed by demand for diabetes and obesity-related treatments. This pullback might be noise, a temporary overcorrection driven by sentiment rather than substance. But remember, don't ignore the risks. Regulatory changes, clinical failures, and growing competition could still shake things up. The bottom line? This crash could be the buy-the-dip setup long-term investors dream of. So, here's the deal. Watch Novo Nordisk like a hawk. Be sharp, be strategic, and as always, invest wisely. That's all from me today, but, oh boy, keep your eyes peeled. This one's far from over.